Hello. In this presentation, I'm going to look at sources of finance, i.e. how and from where organisations will raise the finance they need in order to operate. This analysis and discussion makes up the financing decision referred to in the Objectives of Financial Management presentation. Specifically, this presentation will cover the general concepts underlying the decision, short-term sources of finance, long-term sources of finance, implications of the decision made, raising equity, rights issues, and Islamic finance. Let's look at each of these in turn. General concepts underlying the financing decision. There are two basic guidelines to bear in mind as you consider and compare the various sources of finance that are potentially available. 1. The link between risk and return. This is discussed further below. And 2. There are two parties involved in a financing transaction, namely the lender and the borrower, and there must be benefits to both if the transaction is to go ahead. Imagine a scenario where you have £1,000 to invest. You could put your money into a bank or building society account. However, whilst your money would be safe, you are extremely unlikely to lose the money, you will not generate a particularly attractive return. Alternatively, you could consider putting your money into a company, i.e. buy shares. Unlike the previous option, your money is certainly not safe. Indeed, there is a very real possibility that you could lose your £1,000. This begs the question as to why you would take the risk. The simple answer is the potential to make a much higher return. In other words, you would only take the risk if there is the potential to get a higher return, and the higher the risk is perceived to be, the higher the potential return required. Ultimately, a risk may be seen as so high that you cannot foresee the necessary return and so will not be prepared to invest. Short-term sources of finance. There are a number of ways that a company can raise money where the need is short-term, i.e. up to around 12 months, and it is important to consider the pros and cons of each. Some of these sources are considered below. An overdraft is a facility whereby an organisation can spend more money than it has in its account. Effectively, it is spending the bank's money rather than its own and will be charged interest for the privilege. There is also likely to be a penalty fee imposed where the facility is not agreed with the bank in advance or where agreed limits are exceeded. An overdraft is quick and easy to arrange and is very flexible in that you only use what you need to at any point in time. The interest rate incurred is likely to be higher than that on a loan. However, it can still work out cheaper as interest will only be applied to the amount used rather than the whole amount agreed as with a loan. The major drawback of an overdraft is that it can be recalled by the bank at any time. A short-term loan is an advance of money by a bank or similar institution to a company for an agreed period of time, and, like the overdraft, is relatively quick and easy to arrange. Interest will be applied to the outstanding loan balance periodically. To some extent, the pros and cons are the opposite of those explained above in relation to the overdraft, i.e. it cannot be recalled, unless any pre-agreed terms and conditions are breached, and it is a lower rate of interest. Conversely, it is less flexible and interest will be applied to the whole balance even if the company does not require it all at a particular time. Commercial papers are issued by companies and are effectively a formal IOU agreement. They enable organisations to raise relatively large amounts very quickly and are extremely flexible in that the terms can be whatever the company and the investor agree. A slight drawback is that they can only be issued by very large companies with excellent credit ratings. Trade payables, whilst not normally thought of as a source of finance, is effectively borrowing from your suppliers. It is a readily available, free source of finance. However, companies should guard against damaging the goodwill with a supplier. Payables are discussed in more detail in the Management of Receivables and Payables presentation. Long-term sources of finance. Where the financing need is longer than 12 months, the sources can be categorized between debt and equity. Strictly speaking, equity refers to raising money by issuing ordinary shares. However, preference shares are sometimes considered under this heading. Investors acquiring shares are referred to as shareholders, and in the case of ordinary shareholders, they are the owners of the company and will be entitled to vote on matters raised in open meetings. In return, they may receive a dividend if the directors deem sufficient funds are available. The attraction to the company is the flexibility to only pay what they can afford, whilst the attraction to the shareholder is the potential to make a limitless return. Preference shareholders do not usually get a vote, and dividends that are paid, like the ordinary dividend, is at the discretion of the directors, are a fixed percentage of the nominal value. For example, 6% £1 preference shares will pay a dividend of 6 pence, 6% of £1, assuming one is paid at all. Preference dividends have to be paid before ordinary dividends, and in the case of cumulative preference shares, dividends not paid in 1 year are carried forward to the next. Accordingly, in the above example, if the 6 pence is not paid 1 year, 12 pence can be paid in the 2nd year, 18 pence in the 3rd, etc. A company must be fully up to date with preference dividends before it can consider paying anything to ordinary shareholders. Debt can be raised either in the form of a loan, the considerations discussed above will still apply, or via what might be termed tradable debt, i.e. debt that can be sold on from one investor to another in much the same way that shares are traded. The company will issue a debenture certificate, similar to a share certificate, as proof of monies invested, and the funding may be referred to as debentures, bonds, loan stock, debenture loan stock, etc. More detail on debentures can be found in the cost of debt presentation. Another source of debt finance is the use of leases, and these again will be the subject of a separate presentation. Implications of the decisions made. A company will need to consider the pros and cons of particular sources within the context of their individual circumstances. However, a major consideration will be the implications of using debt as opposed to equity. There are advantages to using debt, not least of which is that it is usually cheaper than equity due to the lower risks faced by the investor. The costs of debt and equity will be covered in separate presentations. Other advantages will include interest will usually attract tax relief, making it even cheaper still. The fact that interest must be paid makes cash flow forecasting easier and can act as a discipline on management that they understand and plan their cash resources. Taking on debt can send a signal to the markets that management have confidence in their cash flows, as otherwise they would presumably not wish to burden themselves with debt obligations. Conversely, as referred to above, debt brings with it a financial obligation in that interest and potentially the redemption of the loan have to be met. Failure to do so may result in the company being forced into liquidation. Consequently, a company that cannot meet its interest obligations, or even is perceived to be unlikely to meet them, is seen as a high risk. This higher risk level may increase the cost of debt or potentially make debt sources unavailable. Summarising, whilst there are benefits to using debt, the company must guard against taking on financial obligations that it cannot meet. The debt level can be assessed and compared to industry norms by calculating the gearing level, debt as a percentage of equity, and interest cover, PBIT divided by interest, which assesses the ability of the company to pay its interest. Raising equity. Where a company already has shares in issues, any new shares must, in the first instance, be offered to existing shareholders. This is called a rights issue and is discussed in more detail below. Where a company is looking to issue shares for the first time, or where they have existing shareholder permission to do so, a company can issue shares externally, i.e. to new investors. In so doing, they will want to do so as quickly and cheaply as possible. Accordingly, their first choice is likely to be a placing, i.e. they place the shares to be issued with an institutional investor. Merchant banks will assist in identifying potential investors. However, there will be a limit as to how much can be raised via this method. For large share issues, a public offer is likely to be used. Now, shares can be obtained by anybody. However, it will be expensive, as the issue will need to be advertised, administered, and underwritten. Underwriting refers to an institution agreeing to buy up any shares not subscribed for by the public. Any shares bought up in this way will usually be acquired at a discount to the issue price, and there will be a fee paid to the underwriter even if their services are not ultimately required. Rights issues. When a company wants to raise capital by issuing new shares, in the first instance these shares have to be offered to existing shareholders. In other words, existing shareholders have the right, known as preemptive rights, to first refusal on new shares. Usually these shares are offered at a discount to the current share price, 18 to 20% is typical, and this will cause a dilution of the share price. The price at which the shares will trade after the issue is referred to as the theoretical ex-rights price, or TERP, and can be calculated as follows. Imagine that a company offers a 1-for-4 rights issue at a 20% discount to the current share price, the cum rights price, of £2. This means that an existing shareholder has the right, though not the obligation, to buy one new share at the rights price of £1.60, £2 less a 20% discount, for every 4 shares currently held. To calculate the TERP, consider a shareholder who holds 4 shares worth £8, 4 times £2. If they exercise their right to buy the new share at £1.60, they will then own 5 shares worth £9.60, £8 plus £1.60, which produces a share price of £1.92, £9.60 divided by 5 shares. As referred to above, shareholders are not obliged to take up the rights offered and are also entitled to sell them to other investors who are interested in buying shares in the company. In theory, the rights will be sold for the difference between the TERP and the issue price. So £1.92 minus £1.60 equals 32 pence in the above example. In practice, the rights value will be influenced by the desirability of the share purchase. Based on theoretical values explained above, the wealth of an investor will remain the same as long as they do something, i.e., either exercise or sell the rights. It should also be noted, however, that a shareholder who sells their rights will relinquish some of their control. Islamic finance. Islamic finance is a rapidly growing area in finance and is not just restricted to Islamic banks. Islamic finance products are products that are Sharia compliant, i.e. acceptable under Islamic law. This is an extremely complex area, and this presentation is not intended to give more than an overview. However, there are 2 basic principles. 1. The earning of money from money, i.e. interest or riba, is immoral. Instead, money should be earned from business endeavour. And 2. Traditional debt approaches are unfair in that the lender receives a guaranteed return irrespective of the borrower's outcome. For example, the lender receives the agreed rate of interest, let's say 5%, whether the funded business makes 0% or 20%. Accordingly, Islamic finance products are all concerned with sharing the risks and rewards in some way, and examples of products include the mudaraba is a form of partnership whereby one partner provides capital and one provides expertise. Profits are shared according to a predetermined agreement, however, all losses are borne by the lender. The musharaka, similar to the mudaraba, however, all parties input capital and all parties can be involved in the management of the business. Profits are shared according to a predetermined ratio, while losses are shared according to capital amounts input. The muaraha. A bank acquires assets at the request of a client and sells them to the client at a markup, often for a deferred payment. The markup reflects the services provided by the bank and the risk carried by the bank that the client may not complete the purchase. Ijara is similar to a traditional lease, and a bank will purchase an asset and rent it to the company for a predetermined period. At the end of that period, a new current rate can be agreed for a subsequent period of use. Thank you.
Welcome to F9 Financial Management. In this section, I will go over capital structure theories and practical considerations. In this video, we are going to look at the traditional theory of capital structure. We're then going to look at Mogliani and Miller's theory of capital structure. And finally, we will look at the pecking order theory. The traditional theory of capital structure. What is the ideal capital structure? What is the ideal balance between debt and equity financing? As I've said in earlier videos, a little bit of debt is believed to be good for the WACC, as it will lower the cost of finance. This is the traditional view of capital structure, which is represented in this graph. The cost of finance is lowest when there is some debt. But look, once a certain gearing level is reached, the cost of capital dramatically increases. As we discussed in video sources of finance and their relative costs, the gearing that debt finance introduces to the capital structure can cause many issues that cause the WACC to increase. Once debt goes over a certain level, the cost of equity and debt increases. The traditional view is realistic. But what is the problem with this theory? The main issue with the traditional theory is that apart from trial and error, we don't know what level of gearing will reach the optimal level. We don't know how much gearing will affect the cost of equity and debt, and by how much. We can only just try and get this balance right. Mogliani and Miller's theory of capital structure. Their theory argues that investors are rational, and their required rate of return of equity is directly proportional to the increase in gearing. So there is a linear relationship between the cost of equity and the gearing. So the increase in the cost of equity offsets the benefits of cheaper debt finance. So the WACC is unchanged. Let's look at the graph to demonstrate their theory. As you can see, the WACC lies between the cost of debt and equity on the graph. It is constant. As any increase in the gearing will increase the cost of equity, it is offset by the cheaper debt financing. So the WACC remains the same. There are a few key assumptions that Mogliani and Miller's theory makes. Firstly, that there is no corporation tax. Secondly, that it operates in perfect capital markets where all investors have the same information and they react rationally to it. And finally, that there are no transaction costs and that debt is risk-free. Now, seeing the assumptions that underpin this theory, you can imagine that there were many criticisms, particularly that it assumed no tax. When looking at capital structure, tax is very important. Why? Because the interest payable on debt is tax deductible, so it impacts on the cost of debt. So the model was revised to include tax. This model still assumed perfect market conditions and that investors were rational and the required rate of return of equity is directly proportional to the increase in gearing. The adjustments were that since debt interest is tax deductible, the cost of debt is less than the original theory. This reduced debt cost means that returns are more predictable. Since returns are more predictable, the costs of equity, in other words, the investor's expected return, do not go up as much as the initial theory did without corporation tax, as it did when gearing went up. This is because debt is not seen to introduce as much risk to investors as the initial theory. Since the increase in the cost of equity does not completely offset the benefits of cheaper debt, the WACC falls as gearing increases. And that is, in a nutshell, what it is. The WACC falls as gearing increases because the introduction of corporation tax makes the debt financing, it reduces the risk that the debt financing is seen to introduce. So, what does this mean? The revised theory indicates that the WACC reduces with gearing and that the company should use as much debt finance as possible to increase the market value of the company. This is very different from what you might have learned so far, and there are a few strong arguments against adopting Modigliani and Miller's theory. The first one is that increased gearing increases bankruptcy risk. If shareholders become concerned about bankruptcy, they will sell their shares in the company. The share price will drop and the WACC will increase. Debt financing, as you learned in earlier videos, can place restrictive conditions on companies and limit the activities of management. Charges can be placed on assets restricting management activities. Other restrictions that debt financiers can place on an organisation is restrict the levels of dividends that can be paid to shareholders. They can also limit the level of debt that the company can take on. So the level of debt a company can take on has a limit, one that is imposed by the debt financiers. Tax exhaustion. This means that after a certain level of gearing, the interest charges cannot be offset against tax. This increases the cost of debt. Modigliani and Miller's theory assumes perfect capital markets to operate. In the real world, our markets are not perfect, and these market imperfections are another argument against their theory. Specifically, it assumes that in a perfect market, there are no concerns about bankruptcy. And by now, you are very aware that this is something investors do worry about and will want higher returns to compensate for this risk. Now, let's look at the pecking order theory. This theory states that organisations have a preferred hierarchy for financing. They'll firstly use internally generated funds like retained earnings. These funds are available and there are no transaction costs such as administration fees associated with them. Then the company will look to use debt financing. There are a lot of benefits of debt financing. As we've said, it is cheap. It can reduce the WACC. If it is secured by an asset, it is even cheaper. And there is far less work that goes into raising debt finance than equity finance. And debt financing is suitable for shorter term projects because it can be paid back and there is no control sacrificed. The last option a company will look at is raising equity finance. Raising finance in this way, for example, through a share issue, is very time consuming. There is an awful lot of administration fees and administration work to be done. And it would need to be for a permanent investment, as the company is diluting control by raising this finance. They will also have to consistently invest resources in maintaining shareholders' relations. So, how would this theory impact on investment? This theory means that the value of a project would depend on how it is being financed. It also means that some projects will only be undertaken if they can be funded internally or with risk-free finance. And the pecking order theory means that companies with less cash and higher gearing will be more prone to underinvest.
Hello. In this presentation, I'm going to look at the cost of equity, both from a calculation and a meaning perspective. Equity was introduced in the Sources of Finance presentation, and it may be beneficial to watch that presentation first if you've not already done so. Specifically, this presentation will cover what the cost of equity represents, methods for calculating the cost of equity, the dividend growth model, estimating growth, and the capital asset pricing model. Let's look at each of these in turn. What the cost of equity represents. The cost of equity is the return required in order to satisfy equity shareholders. As discussed in the Sources of Finance presentation, dividends are not guaranteed, and neither is it certain that share prices will increase. Despite this, shareholders invest in the hope or expectation that one or both of these things will happen. Indeed, it is this variability or uncertainty in the outcome that is described as risk, and given that the risk, i.e. variability, is high, the return required, and therefore the cost of the company, will also be high. Despite all of the above, even though a shareholder return is not guaranteed, companies still need to be aware of the return required to keep investors happy in order that they can allocate funds to appropriate projects. It is the estimation of the return required that we turn to now. Methods for calculating cost of equity. Broadly, there are two approaches to estimating the cost of equity. One, dividend growth model, and two, capital asset pricing model, or CAPM. I deliberately use the term estimate rather than calculate, as there are drawbacks or weaknesses to both approaches. Accordingly, when considering the two approaches, it is important to consider the calculation itself, assumptions made, and weaknesses or drawbacks. Let's look at each approach in turn. The dividend growth model. The dividend growth model values a share as the present value of its future expected dividend stream. In other words, it assumes that when an investor is determining how much to pay for a share, they 1. Estimate the dividend stream, 2. Determine their required return, and 3. Discount the dividends at the required rate of return to arrive at the share price to be paid. Whether this actually is the thought process that investors go through can be challenged. However, using this process, if a company knows the share price and can estimate the dividend stream, they can calculate the discount rate applied, i.e. the return required by shareholders. This is represented by the following formulae. For preference shares, the cost of preference shares, KP, equals the dividend D divided by the current share price, P0. For equity shares, the cost of equity, KE, equals the dividend in 1 year's time, D1, divided by the share price now, P0, plus G, the percentage growth in dividends per annum, expressed as a decimal. D1 can also be shown as D0 multiplied by 1 plus G, the current dividend increased by a year's worth of growth. The slight difference between the formula for preference and equity shares is simply because the preference dividend is a fixed percentage and doesn't grow. The drawbacks of this approach are: 1. The validity or otherwise of the underlying assumption of the investor's thought process discussed above. 2. It can only be applied to companies whose shares are listed and regularly traded, i.e. they have an accurate share price. 3. It can only be applied to companies who pay a dividend. 4. It assumes that dividend growth rates are constant. And 5. It assumes that the dividend growth rate can be estimated. This last point is discussed further below. Estimating growth. As discussed in the Sources of Finance presentation, dividends are paid at the discretion of the directors based on their assessment of the company's finances at that point in time. Accordingly, nobody can accurately predict in advance the rate at which dividends will grow. Notwithstanding this fact, the dividend growth model requires an estimate to be made, and there are two mathematical approaches that may be adopted. One, based on historic rates. If the latest dividend paid is 50 pence, and recent dividends have been 45 pence, 42 pence, 40 pence and 39 pence 4 years ago, then the dividend has grown from 39 pence to 50 pence over the period. The average rate can then be estimated as the fourth root of 50 divided by 39, which gives 1.064. If you then subtract 1, you are left with 0.064 or 6.4%. It is assumed that this same rate of growth will continue moving forward, albeit this is another assumption whose validity can be questioned. 2. Growth is calculated as B multiplied by R, where B is the balance of earnings retained and R is the return earned. Imagine a company has assets of £100 and makes a return on those assets of 20%. In the first year, the company will earn a profit of £20, 20% of 100. If the company decides to pay a dividend of £5, it will retain the other 15, and so the assets now invested are £115. Assuming the 20% return is maintained, the profit in year 2 will be £23, 20% of 115. Comparing the £23 in year 2 to the £20 in year 1, this represents a growth rate of 15%. This growth is predicted by B multiplied by R, as 75%, the proportion of the £20 profit retained, multiplied by 20%, the return earned, is 15%. Capital Asset Pricing Model. CAPM links the return required by shareholders to the level of risk they face. It does not, however, consider all of the risks as described here. In simple terms, there are two types of risk faced by a company. 1. Unsystematic or specific risk, which are the risks linked specifically to a particular organisation, and 2. Systematic or market risk, which are the risk of being in the market. As a generalisation, when markets fall, all shares fall, and when markets rise, all shares rise. Unsystematic risk can be diversified away by holding a portfolio of investments. For example, if you hold shares in one company and that company is involved in exporting to the USA, you are exposed, amongst other things, to an exchange rate risk. If you buy shares in a second company that imports from the USA, you are now exposed to the same risk, but in the opposite direction. Accordingly, you are no longer exposed to exchange rate risk and so have reduced the overall risk. By holding more and more shares, individual or specific risks can gradually be reduced, and it is estimated that you can largely eliminate unsystematic risk with a portfolio of around 15 to 20 shares. A first assumption of CAPM is that if you can diversify, you will, and therefore unsystematic risk can be ignored. Whilst this may be largely true for institutional investors who employ fund managers for that very reason, it is less appropriate for individual investors. CAPM then assesses the cost of equity by comparing the risk-free return, the return required from a risk-free investment, to the market return, the return required given the average market risk, and is given by the following formula. Cost of equity, KE, equals RF plus RM minus RF multiplied by the beta, where RF is the risk-free return and RM is the market return. Alternatively, RM minus RF is the market premium. Beta is a risk score assessed by comparing the historic volatility in a share price with the volatility in the market during the same period. A beta of 1 indicates that the company's risk is the same as the average market risk. A beta higher than 1 indicates a higher than average risk. A beta lower than 1 indicates a lower than average risk. The drawbacks of CAPM are: it assumes that all investors hold diversified portfolios. It assumes that the historic risk relationship estimated by the beta holds true moving forward. It assumes that reliable figures for RF and RM can be established. In practice, the return on government stocks is often taken as an indicator of risk-free. Finally, it can be argued that having only one indicator of risk is too simplistic. Thank you. Hello. In this presentation, I'm going to look at cost of debt, i.e. the cost to the company of servicing its debt obligations. Debt was introduced in the Sources of Finance presentation, and you may wish to watch that first if you have not already done so. Specifically, this presentation will cover the meaning of the cost of debt, the cost of bank loans, the cost of irredeemable debt, the cost of redeemable debt, the cost of convertible debt, and terminology. Let's look at each of these in turn. The meaning of the cost of debt. As discussed in the Sources of Finance presentation, when a company is looking to raise finance, there must be benefits to both the borrower and lender. The benefits to the company were discussed elsewhere. However, it is important to also think about the benefit to the investor. In short, this is a guaranteed rate of return. Guaranteed in the sense that the company cannot choose whether or not to pay, in the way that it can with the equity shareholders' dividend. The return itself can be provided in a number of ways, namely interest on outstanding amounts, paying back more than was borrowed, i.e. a premium on redemption, or anything else that may be attractive to a potential investor, sometimes referred to as a debt sweetener. The company does not need to provide all three elements, but merely to find a combination of one or more of the three that is sufficient to satisfy investors. Ultimately, it is the combined cost that is of interest to the company and must be calculated. The way or ways in which the return is provided will impact on the way that the cost of debt is calculated, and we will now look at these techniques. It is the cost to the company of providing the necessary return that is represented by the cost of debt. The cost of bank loans. When a company borrows from a bank, they will repay the original loan or principal as well as interest. Interest will be calculated periodically on the outstanding principal according to the loan agreement. The calculation of interest was considered in a little more detail in the discounting presentation. With a bank loan, the amount borrowed is the amount repaid, i.e. there is no premium on redemption, and so the only cost is the interest. It is important to remember, however, that, unlike dividends, interest is tax deductible. In other words, if a company pays interest, this is an expense that will reduce its profit and therefore its tax bill. Accordingly, the cost to the company is the interest rate applicable to the loan multiplied by 1 minus T, where T is the tax rate. If a company takes out a loan at 6% and the tax rate is 25%, the cost of the loan is 4.5%. That's 6% multiplied by 1 minus 25%. To demonstrate this tax deductible aspect, consider two companies, A and B, who both have profit before interest and tax of 100. Company A has an interest expense of 10, thereby reducing their PBT, profit before tax, to 90. If we now deduct tax at 30%, Company A will pay 27, 30% of 90, and B will pay 30, 30% of 100. The PAT of the two companies is therefore 63 and 70 respectively. The end result is that although A has paid 10 in interest, its profit after tax has only decreased by 7, 70 minus 63. This could have been predicted as 10 multiplied by 1 minus T, or 70%, is 7. The cost of irredeemable debt. Irredeemable debt is debt that is never repaid. Initially, this appears to be a very strange concept, i.e., why would you lend money knowing that it would not be repaid? However, it is important to remember that we are talking about tradable debt, and as such, the original lender can simply sell the debt to somebody else when they want their money back. In many ways, this is exactly the same as when an equity shareholder buys shares in a company. They will have no expectation that the company will buy the shares back, but are free to sell them at any time. Indeed, the cost of debt can be calculated using the dividend growth model introduced in the cost of equity presentation. The one difference is that, as discussed above, interest is tax deductible, and so the formula becomes interest I multiplied by 1 minus t divided by the current price P0. Debentures are usually issued with a nominal value of 100, and this would be assumed to be the case unless you are told to the contrary. They may trade at a higher or lower than this figure, depending on the attractiveness of the debenture. This latter number is described as the market value and can be expressed either as a monetary value or as a percentage of the nominal value. For example, a company has some 5% irredeemable debentures in issue trading at 95%. The 5% denotes the rate of interest expressed as a percentage of the nominal value. If the tax rate is 20%, what is the cost of debt? Well, I equals 5% of 100, which equals 5. T is 20% or 0.2. And P0 is 95% of 100, which equals 95. So the cost of debt equals 5 multiplied by 1 minus 0.2 divided by 95. That equals 0.042 or 4.2%. The CAPM method, introduced in the cost of equity presentation, can also be used if you have a debt beta for the company. The cost of redeemable debt. Redeemable debt is debt that is bought back or redeemed by the company that issued it. This is usually at a predetermined time and price. For example, 5% debentures 2018 denotes that the debentures will be redeemed in 2018 and that interest at 5% of the nominal value, assumed to be 100 in the absence of anything to the contrary, will be paid in the meantime. Redemption will take place either at par, at the nominal value, at a premium, at higher than the nominal value, or at a discount, below the nominal value. A debenture being redeemed at a premium would usually offer a lower interest rate than one being redeemed at par or at a discount. This is because the lender will benefit from the gain on redemption and so does not need so much interest to entice them to invest. Accordingly, the total return is made up of interest and a premium on redemption, and so the dividend growth model approach, which only considers the interest element, can no longer be used. Instead, an IRR approach must be adopted. It is probably easiest to look at this from the perspective of an investor buying a single bond. Let's look at the following example. A company has 5% redeemable bonds in issue, currently trading at 95%. Interest is paid annually and they are due to be redeemed at a 10% premium in 4 years' time. Tax rate is 20%. What is the cost of debt? Split your page into 6 equal columns. Head the first column time and the second column pounds. On the first row, enter 0 under time and negative 95 under pounds. On the second row, enter 1 to 4 under time and 4 under pounds. Finally, on the third row, enter 4 under time and 110 under pounds. These first two columns show the cash flow for an investor buying a single bond, namely pay out £95 immediately to acquire the bond at its market value, and then receive interest for each of the next 4 years and the redemption value in 4 years. Because we're trying to calculate the cost of debt to the company, it is shown net of tax. So £100 multiplied by 5% multiplied by 1 minus 0.2 equals £4. Redemption is at a 10% premium, so the amount received will be £100 plus 10%, which equals £110. It can be seen that the investor gets more back, 110 plus 4 lots of 5, than they invest, 95. And we can use the IRR approach to estimate the percentage return achieved. Firstly, choose a percentage that is likely to be somewhere near the final answer. For example, 5%, although other percentages would be equally acceptable. In the third column, enter the discount factors for 5% and each of the time periods. At time 0, the discount factor is always 1. The interest is received each year, and so the annuity table is used. The debt is only redeemed once, so the present value table is used. More guidance on using discount tables can be found in the discounting presentation. In the third column, you can now add the 5% discount factor on each row, and then in the fourth column you can multiply the cash by the discount factor to arrive at negative 95, 14.18 and 90.53 on each row. Adding the column down, the present value is 9.71 positive. The fact that it is positive indicates that the actual return is higher than 5%, and so the discounting process is repeated using a figure higher than 5%. I have used 10%, however, other figures were equally acceptable. The discount factors in column 5 will be 1, 3.170 and 0.683, and the present values in column 6 will be negative 95, 12.68 and 75.13, which produces a total present value of negative 7.19. The numbers calculated can now be used in the IRR formula. A, the lower of the two percentages used, plus NPVA, the NPV at that percentage, divided by NPVA minus NPVB, the difference between the present values, and multiplied by B minus A, the difference between the percentages. In this example, plugging the numbers into the formula, you get 5 plus 9.71 divided by 9.71 minus 7.19 and multiplied by 10 minus 5. This produces a cost of debt of 7.87%. Note that you may get a slightly different answer if you have used different percentages initially, and hence the cost derived can only be an estimate. The cost of convertible debt. Convertible debt is essentially redeemable debt. However, at redemption, the debt holder has the option to receive equity shares rather than cash. The number of shares received is defined by the conversion ratio. For example, if a £100 bond can be converted into 20 shares, the ratio can be expressed as 20, or alternatively, that one share equals £5 of bonds, 100 divided by 20. The cost of debt is calculated in exactly the same way as the redeemable debt. However, on the last row, you use the higher of the redemption value or the conversion value. The assumption being that given the choice, this is how the debt holder will decide. The conversion value is the number of shares received multiplied by the market price per share. Imagine you are offered a convertible bond currently trading at £105 that has the option to convert into 20 shares. If the debt holder was making the decision today, they would sell the debt for £105 rather than converting for £95. Further, this can be expressed as a conversion premium of £10, 105 minus 95, or 10.5%. That's 10 divided by 95, the conversion premium divided by the conversion value. Whilst conversion is not currently attractive, it should be remembered that there will often be an assumption that share values will increase over time. Specifically, in this example, share prices would need to increase by 10.5% before the conversion option started to become attractive. Companies will want to set the premium low enough to be attractive to investors without offering more shares than is necessary. Assuming that the conversion option is attractive, i.e. it has a value to investors, the company will not need to offer as much interest as on non-convertible debt. Terminology. Finally, you may come across the following terms in conjunction with tradable debt. Debentures may also be described as loan notes, loan stock, and bonds. The interest rate is described as the coupon rate. Debentures that don't pay any interest, i.e. they attract investors in other ways, are described as zero coupon. A debenture that is issued below its nominal value, thereby increasing the premium on redemption, is described as a discounted bond. Where the discount is high, typically 15 to 20%, the term deep discounted bond is used. Thank you. In this presentation, I'm going to look at the weighted average cost of capital, or WACC. In separate presentations, I have covered the cost of debt and the cost of equity, being the returns required to keep debt holders and shareholders satisfied. In practice, firms will often raise finance from a number of sources simultaneously, and so they will need to be able to calculate the overall or average return required. Specifically, this presentation will cover the meaning of the WACC, calculating the WACC, limitations of the WACC, and a project-specific cost of capital. Let's look at each of these in turn. The meaning of the WACC. When investors put money into a company, whether they do so in the form of debt or equity, they are looking for a return on their investment. In order that the company can make appropriate investment decisions, i.e. ensure the return anticipated is sufficient, they need to estimate the level of return required. An added complication is that different investors face different levels of risk, and so will have different expectations as to the return they require. Accordingly, the various returns required have to be averaged to obtain the overall cost to the company, and it is this that is referred to as the weighted average cost of capital. Calculating the WACC. The easiest way to approach the calculation of the WACC is to think of it as a four-step process. 1. Identify the sources of finance. 2. For each source, identify the market value. 3. For each source, identify the cost. And 4. Combine the information in the WACC formula. Sources of finance have been discussed separately in the sources of finance presentation, and similarly the cost of debt and equity have been covered elsewhere. The market value of finance will be the value at which the source can be traded. For equity, this equates to the number of shares in issue multiplied by the share price, whilst for debt, this will be the number of bonds multiplied by the quoted price per bond. Remember that this quoted price can also be expressed as a percentage of the nominal value. Finally, if one of the sources is a bank loan, it does not have a market value, it cannot be traded, and so the loan amount is used instead. The WACC formula can be expressed as the cost of equity multiplied by the market value of equity and divided by the market value of equity plus the market value of debt, i.e. the cost of equity multiplied by the proportion of the total finance represented by equity. This is added to the cost of debt multiplied by the market value of debt and divided by the market value of equity plus the market value of debt. This assumes that there are two sources of finance, one equity and one debt. However, any number of sources can be accommodated by applying the above logic, i.e. the cost multiplied by the proportion of the total represented by the source under consideration. Limitations of the WACC. As discussed in the sources of finance presentation, there is a direct link between the risk faced by investors and the return required by them. Accordingly, when a company calculates its WACC, it is based on current risk levels. The limitation this presents is that if they are trying to identify the return that will be required from a project under consideration, they are, in effect, assuming that the project will not change the underlying risk profile of the company. Further, the WACC can only be used where this is the case. The risk profile refers to both the relative proportions of debt and equity, the financial risk, and the business area of the new project compared to the current company, the business risk. If either or both of these changes, then it is no longer appropriate to use the existing WACC as the measure against which the project is assessed. If this is the case, then a marginal or project-specific cost of capital should be derived and used to assess the project. This process is discussed further below. A project-specific cost of capital. As discussed above, the total risk faced by an organisation can be broken down into two elements. 1. Business risk and 2. Financial risk. It is essential that the return required from a project takes changes in both of these into account to ensure that the anticipated return is sufficient compensation for the risk taken on by investors. Where a project being considered will change the business risk of an organisation, the following approach can be adopted. 1. Find a similar company that already operates in the new business area, a proxy company, and identify their beta. Betas were introduced in the cost of equity presentation. This beta recognises the total risk profile of the proxy, both business and financial, and is referred to as an equity or geared beta. 2. Whilst this beta reflects the business risk of the new project, it is unlikely that relative debt levels in the proxy and the project will be the same. Accordingly, strip out the financial risk of the proxy, referred to as ungearing the beta, using the following formula. The equity beta multiplied by the value of equity divided by the value of equity plus the value of debt net of tax, added to the debt beta multiplied by the value of debt net of tax divided by the value of equity plus the value of debt net of tax. If the debt beta is 0, the second half of the formula can be ignored, and the value of debt net of tax is simply the value of debt multiplied by 1 minus t. 3. The new beta derived in step 2 only reflects the business risk and is referred to as an asset or ungeared beta. Before this can be used, therefore, it needs to be adjusted to reflect the finance risk of the company. The process for doing this is the opposite of the ungearing in step 2, uses the same formula as above, and is referred to as re-gearing. 4. The beta now obtained is an equity beta for the company that reflects the business risk associated with the new business and the finance risk associated with the debt levels of the underlying business. Using this beta in the CAPM formula will calculate an appropriate cost of equity, which can in turn be used to calculate a WACC. Thank you.
In this section, I will go over finance for small and medium-sized entities, otherwise called SMEs. In this section, we are going to look at the financing needs of small businesses, the financing problems for small businesses, solutions to solve small businesses' financing problems, and the financial impact of sources of finance for SMEs. The financing needs of small businesses. Small businesses, like large ones, need money to fund their activities and working capital. Yet it can be much more difficult for smaller businesses to get finance than larger ones. Small businesses often find it very difficult to get credit, but they are in the difficult position where often they have to offer credit to their customers to remain competitive. Small businesses are typically new and without a track record or a history, and it is very difficult to secure finance as they are seen as riskier than larger organisations by financiers. Small businesses need to fund their startup costs, be able to supply credit to their customers, which is one aspect of their working capital that they will need to fund. As well as these costs, they need to fund. SMEs will need funds for their future, to grow their business, to invest in profitable projects. Financing is extremely difficult, as you can see, for smaller organisations, and the sources of finance available to them are limited, and much more so than the sources available to larger organisations. Typically, the sources of finance available to an SME is retained earnings, so these are previous year's profits, bank borrowings. Bank loans can be very difficult for small businesses to get. I'll go over the reasons for this on the next slide. It is often remarked that SMEs can get a long-term loan, such as a mortgage, and not a short or medium-term loan. This is referred to as the maturity gap, and it means that SMEs can find it very difficult to match short-term projects with short-term finance if the only source of finance available is a long-term source. Why is this? Because long-term loans are easily secured or easier secured by an asset which the company could have. So you could secure a long-term loan such as a mortgage against a company property. However, the bank will not offer a short-term loan with the same asset against it, and the company will not have the track record to get the short-term loan. Another source of finance available is from seeking additional finance from their current shareholders. So, for example, a rights issue. It is quite difficult to sell additional shares in a small company, much more so than for a larger quoted company. To seek money from existing investors assumes that they have the finances to invest, which is often not the case. Often, a small company's main investors are the founders themselves, who have already exhausted their savings trying to set up the business. Increasing your investment in an SME is not very attractive for many investors, as they will not be able to sell their investment as they could on the stock exchange. Another point I want to make is that these are unlike stock exchange investors who have studied the market and buy shares to diversify their portfolio and to get high returns, etc. Often, SME investors invest for a very different reason. They invest because of, say, a friendship, or because that they really believe in a product or the service being provided. SME investing is very risky, as most do fail within 2 years. A funding gap occurs when SMEs want to expand and need more finance than what is available to them. But they are not yet big enough to get access to the funding available from the stock exchanges. They are not ready or able to apply to the stock exchange or the alternative investment market for a stock exchange listing to raise this finance. Financing problems for small businesses. So the lack of available credit is a big problem for SMEs. Why is this? As I already said, they are often new businesses, so they have no credit history. Often they have no assets that can be used as collateral. Also, smaller businesses are more vulnerable to market forces. Therefore, their situation can change quickly. This volatility would deter financiers, and if they do decide to lend, they will monitor the activities of the SME and can place many restrictions on them. So, by now, you should be fully aware that it is difficult for SMEs to get finance, and they face difficulties such as lack of collateral, the maturity gap, and the funding gap. So, what can be done to ease these problems? Here are a few alternative sources of funding that can bridge the funding and the maturity gap. Venture capitalists. They offer finance for an equity stake in a business. They give large sums to high growth companies. Venture capitalists are a department of most major finance providers. Since they don't offer smaller funds than typically less than $100,000. For businesses seeking a smaller investment, there are business angels. Business angels are wealthy individuals who typically offer smaller sums to high-growth businesses. Often, they offer business expertise to help that startup. This is a very risky investment for the business angel. So they will want a high return or a big stake, as in percentage ownership in the company for their investment. Are you familiar with TV shows such as The Dragon's Den or The Shark Tank? The investors in these would be classed as business angels. I recommend you watch an episode of these shows. Although they are for entertainment purposes, they will give you an idea of what this type of investor wants to know. Another financing option is crowdfunding, which is also called peer-to-peer financing. This is where businesses seek funding from the public at large. They may want to raise $100,000, but each investor may donate as little as, say, $20. The business will showcase their product and display their future plans, and sometimes pre-sell their product. This is a very popular option for startups, as it serves as a marketing platform, and the organization can test their product on the target market and assess the market's reaction to their offering. There are fees to be paid with this source of finance, and normally, if the organization does not reach its target investment, they don't get the investment. So it can create pressure. Check out the crowdfunding website Kickstarter to get a sense of what information companies are providing. Supply chain financing is where the organization can get credit in their supply chain to fund working capital. So, for example, they get 30 days credit from suppliers, or perhaps customers pay in advance for a product or service. It is hard for new companies to get trade credit, but if they do, it's great because it's free. Government intervention. Small businesses and startups are very important to the economy and to the country's jobs market, so governments often take measures to fund them. There are two main ways this is done. They increase the marketability of the organization's shares, or they can provide tax incentives to the investors. Increasing the marketability of an organization's shares has been done in some countries by creating a small firms market. By creating this, smaller organizations can sell their shares more easily than before to the public, raising equity. This is also much more attractive to those who are investing because it increases the marketability of the shares, and they can sell them on if they need to realize their investment. Providing tax incentives to investors, to small firms, means what it says. It often gives investors who have a high tax bill a win-win situation. They can offset some or all of their investment, even if it is profitable, against their tax bill, depending on the type of tax incentive being offered, of course. This takes a lot of risk out of investing in smaller firms, so if the investor doesn't receive a return on their investment, they can still reduce their tax bill. Governments often use these types of incentives to stimulate areas in the economy. So, for example, to develop environmentally sustainable energy, or the film industry, Other ways governments assist SMEs is by providing grants and small loans. These are very useful for organisations who cannot access bank financing. Welcome to F9 Financial Management. In this section, I will go over sources of finance and their relative costs. Please review F4's videos on loan and share capital to revise the basics. In this video, we are going to go over the following: debt versus equity, the creditor hierarchy, issues with high levels of gearing, and using the weighted average cost of capital versus the capital assets pricing model in investment appraisals. You'll have seen this from earlier videos, that there are two categories of finance within a business: debt and equity. Debt financing is sourced from outside the organisation. A bank loan is a common source of debt financing. The costs of debt financing is the interest rate charged by the lender. This will depend on a variety of factors: the creditworthiness of the organisation, the current market conditions, the amount of finance being sought, etc. Debt financiers often require collateral for loans and will take a charge or can take a charge over companies' assets. If the company fail to keep their side of the agreement, the financier can take the asset. Companies' creditors can put the company into receivership and liquidate the company if they are not making their loan repayments. Because of this, debt financing is seen as adding more risk to a company. In business, every investment has a risk. Some shareholders and business owners believe that debt financing is good because the risk associated with it motivates the directors to work hard and create a return to meet the loan repayments. Using debt financing to fund an organisation increases the organisation's gearing. You should already be familiar with gearing, which I will go over later in more depth. Equity financing is sometimes called internal financing, as it is the shareholders' funds. It can be mistakenly viewed as free finance because, unlike a bank loan, there are no scheduled loan or interest repayments. But these are the shareholders' funds in the form of share capital and retained earnings, etc. These investors want a return for their money invested. This return is the cost of finance. And this is the opportunity cost also associated with their funds, because they could put it into another project. Equity financing will reduce gearing, but it can also reduce the current shareholders' power. So, for example, by issuing more ordinary shares, you're diluting the current shareholders' control in the company. So, debt versus equity financing. When looking at finance, you will need to assess debt and equity financing under these following headings. So firstly, gearing and financial risk. Debt, as I've already said, increases the gearing and financial risk. Equity reduces it. So the target capital structure. So the goal of target capital structure is to minimise the weighted average cost of capital. Debt is a cheaper source of finance initially. It must be controlled because otherwise the company will risk financial distress. Equity reduces gearing, and to obtain the ideal capital structure, a mixture of debt and equity need to be maintained. Collateral. Debt finance, as I've said, often requires collateral which will place a fixed or floating charge over the asset. Equity funders don't receive collateral, so the organisation doesn't need an asset to offer a charge over, but instead they have ownership and control of the company. Economic forecasts and expectations. This will dictate the type of loans that the company will undertake. If they expect interest rates to drop, for example, they may choose a variable interest rate loan. And then when investors are looking at their economic forecasts and expectations, they will have certain ones and the returns that they would expect that their investment to achieve. Control. Mentioned this a few times. Debt financing increases the risk but does not dilute the control in the company. So if a company gets a bank loan, the lender cares about the repayments of their loan. They don't have an involvement in how the company is run and how these repayments are made. However, equity financing does have control. The shareholders own the company and have control, so they will have an input into different decisions. The creditor hierarchy. You should already be familiar with this from earlier videos, but let's go over it in more depth. You should know from your studies of investment that the greater the risk, the higher the return. When we examined investment appraisal, you learned about the risk premium applied to investment projects. When an organisation is seeking finance, it is flipped. Instead of appraising the investment, you must view as the organisation as the investment. With this viewpoint, let's look at the creditor hierarchy and the costs associated with the finance. In the event of a winding up of a company, debt financing is paid before equity holders, who are paid after all creditors. First paid are the debenture holders. These are the lenders who secured a fixed charge over an asset. The asset is usually in the form of property, like land and buildings. Since these lenders didn't take a high risk, they had security over the finance that they loaned to the organisation, so the cost of this finance is relatively lower than the following creditors who come after them in the creditors hierarchy. Creditors who had a floating charge over the assets such as inventory. They are more protected than unsecured creditors, but they're also not first paid like the secured creditors who have a fixed charge. Then we have the creditors who are protected by the law. So, for example, in many countries, tax authorities and the employees must be paid before unsecured creditors and shareholders. Next to be paid in the hierarchy are the unsecured creditors. For example, suppliers will be paid. Then we have the equity holders. So the preference shareholders are paid back their investment. And then, after everybody else is paid, we have the ordinary shareholders. They take the most risk. As you can see, they are the only group who didn't get a predetermined amount. All creditors have received amounts billed and the preference shareholders received back their investment, but the ordinary shareholders will receive the balance. As you can imagine, this can be much higher than their initial investment, meaning they can make a big return. But from this hierarchy, you can also see they may receive much less than they invested. Ordinary shareholders face the greatest risk, and their finance as a source for the company is the most expensive. Its cost is the risk-free rate of return plus the risk premium attached to it. The cost of equity finance is also the investor's required rate of return. Given that equity financing is expensive, why not just borrow all the finance? Debt financing, as you've learnt from previous videos, increases the company's gearing. It is acknowledged that some level of debt financing is good for the weighted average cost of capital of a company because it is a cheaper source of finance. But high levels of gearing pose many problems. A highly geared company is considered more risky and is more vulnerable when there is a downturn. This could be in the economy or in consumer demand for the company's product. If they experience dropping sales, they cannot meet the loan repayments. This may cause them to be put into receivership, putting the company into a winding up situation. If they are not wound up, but experience repayment difficulties, the organisation can damage its credit rating, which will reduce finance available to them in the future and may even prevent certain suppliers supplying them with credit. The cost of servicing loans will reduce profits, reducing shareholders' dividends and returns. This could cause them to sell their shares, leaving the organisation open for a hostile takeover. As you can see, there are a plethora of problems associated with high gearing, and this is why having a proportionate amount of equity finance is considered to strengthen a company, and it will be able to service its debt requirements during a downturn, avoiding the problems we've just discussed. So, how do you know if a company is heavily geared? It is important to look at the industry that the company is in. What is the debt to equity ratio of similar sized companies? If it is similar, then it is at an acceptable level. However, if it is significantly higher, it may be too highly geared, and efforts should be made to reduce it. To measure gearing in an organisation, you can calculate it with the following ratios. I discussed ratios in F3 ratios. I recommend that you look at this video and earlier ones. With these ratios, you can look at the extent of the gearing of an organisation and compare it to similar organisations and to the previous years of the company. First is the debt to equity ratio, where you divide the total debt by the total equity. This shows a debt as a percentage of equity. The higher this number, the more highly geared the organisation. Now there is the interest cover ratio. This takes the earnings before interest and taxes divided by the total interest. The higher this number, the better, as it shows the organisation's ability to service its debt. What this number should be depends on the company and the attitude of their investors. A 2 or higher is considered sound, but some companies may require a higher number and others a lower one. Next is the equity ratio, where equity is divided by the asset value. This will indicate the level of leverage of the company and how much of their assets are financed with debt. The higher this number, the more assets are financed by equity. And finally, the debt ratio. This ratio looks at how much the assets have been financed by debt. The total debt is divided by the total assets, and the higher this number, the higher the gearing, and the more assets that have been financed by debt rather than by equity. Debt financing is a very important part of business financing. It is cheaper than equity, as I have said, and its interest costs are tax deductible. However, as you can see the problems arising from gearing, it must be managed carefully. Another type of gearing is operational gearing. This examines the relationship between fixed operational costs and the organisation's overall operating costs. This is examined with the following ratio: fixed operational costs divided by the total operating costs. The higher this number, the more operationally geared this organisation is. This means that if they experience a downturn, they will still have to incur these fixed costs, making it a more risky organisation. On the flip side, with high levels of operational gearing, the cost does not increase with high levels of production and consumer demand, so the organisation can get higher profit margins and avail of economies of scale. Operational gearing is determined by the industry the organisation is in. However, as the organisation can suffer serious losses when demand dips, they will need to forecast and manage this. The gearing we have discussed is risk for the shareholder, and cash flow forecasting can manage this risk, as management will predict future cash flows and match this to debtors' requirements and their equity holders' rates of return. Obviously their forecasts may not always be accurate, but some future planning is needed and it can help manage equity holders' expectations. Funding an asset. One of the main reasons an organisation undertakes financing is to get an asset. They can do this by leasing the asset or borrowing to buy the asset. Leasing finance agreements have changed a lot in recent times, and it is important that you do read the terms and conditions of these agreements carefully, particularly over the area of ownership of the asset. But typically, when leasing an asset, the organisation doesn't own the asset, or doesn't own it until the final lease payment is paid. The leasing company does, and if the organisation fails to make any of their repayments, the leasing company will take the asset back. Leasing agreements differ, but they may offer additional support like maintenance, which will reduce the risk of ownership. If, say, for example, the asset breaks down, they may also replace the asset if it does break. And if the organisation, for example, no longer wants or needs the asset, they can exit the agreement. So, while they may have to pay a penalty clause to do this, but again, it offers greater flexibility. When an organisation borrows to purchase the asset, they incur all the risks and the rewards of ownership, and the extra supports that were available, say, under lease agreements, may not be available. They'll have to get them separately. However, the asset will be theirs. If they no longer need the asset, they'll have to sell it. It's not a case of paying a penalty clause and the asset is taken away. As you can see, owning an asset is riskier than leasing it, and obviously the lease repayments are a little bit more expensive. The management will have to analyse the costs of both options. An NPV analysis is good to do this. So, when we are looking at the mix of debt and equity capital, we are looking at the cost of each. How do they impact the investments that are made? Well, as you've seen from investment appraisals, the discount factor used is largely based on the cost of capital, and a risk premium is then added depending on the project's risk. So, the lower the cost of capital for a company, the lower the discount factor, and the more projects will get a positive NPV when assessed. The weighted average cost of capital can be used in investment appraisal when the project is relatively small, the current capital structure is maintained, so the debt and equity structure remains the same. The project has the same business risk or operating risk. Business risk arises from the nature of the organisation's operations, so their operations will remain pretty much the same. So, what if the company has a project that doesn't meet this criteria? When we look at the capital asset pricing model, which you will have seen in earlier videos, this model examines the cost of equity, which is based on the risks faced by the shareholders. What are the advantages of the CAPM over the WACC when management wants to decide the cost of capital of a specific project? CAPM is used to look at projects that have a different business risk than the company's normal business risk. This model focuses on the shareholders and to maximise their wealth. The model can set the required rate of return that the shareholders want. This may be higher than the WACC given the project has a different risk profile. So let's apply the CAPM. ABC Incorporated had difficulty sourcing finance after the global recession, and it is an all-equity company with a beta of 0.7. Management are looking at investing in a one-year project, which requires an initial investment of $10,000 now. The project will give an expected return of $12,500. This project has a beta of 1.4. The risk-free rate of return is 10% and the market rate of return is 18%. So, looking at this example or this question, what is ABC's cost of equity? So pause this video and attempt. Have you done it? We know that the company has a beta of 0.7. This project has a beta of 1.4. So the risk profile is very different. If this was a risk-free investment, the beta would be 0. The risk-free rate of return is 10% and the average return from the market is 18%. ABC's cost of equity is found by the risk-free rate added to the market risk premium, which is multiplied by the company's beta. So that is 10% plus and then 8% multiplied by 0.7. This gives us a result of 15.6%. So now, what is the cost of financing this individual project? Pause this video and attempt to calculate this now. So, have you done it? Okay, let's begin. The risk-free rate added to the project's beta multiplied by the market risk premium. So 10% plus, and then we've got the risk premium of 8% multiplied by the beta of the project, which is 1.4. That gives a result of 21% and 0.2. So 21.2%. This is substantially higher than the company's cost of equity, but the risk profile of this project is also much higher. Now, should the company invest in this project? Pause the video and calculate your answer. Done? First, we calculate the expected return of the project. So, in 1 year, the cash flows will be $12,500. Deduct this from the original investment of $10,000 and divide it by 10,000. And the return, or the expected return, is 25%. This is above the minimum expected return for the investor, which is 21.2%. So it should be selected. Now, you've probably spent a lot of time looking at the NPV when you're assessing investment projects. So would the NPV tell us that this is a good project? Let's calculate it. So, as you can see from your calculations, the NPV is a positive one. It returns $313. So it is positive, showing that yes, the project should be selected.